So good evening, everyone, and welcome to our seminar this evening on DSTs, the Delaware Statutory Trusts. We started doing this because, or we decided to do this seminar. It wasn't originally planned, but we had our last in-person seminar given by Joe Daly about real estate investing. He mentioned DSTs. And then all the questions were about DSTs to the point where I was like, oh, you know what? Joe is not the expert on DSTs. I know someone. So let me do a seminar on that. And then I immediately called our speaker and said, or I emailed him and I said, are you available? And he graciously agreed to fly up from Southern California to be able to be here today. So I'm really excited about that. A quick market update that I always like to start out with, and then I'll hand it over to our speaker. Median sale price. So the data here has to do with single-family homes in San Mateo County. So median sale price of single-family homes in San Mateo County, the median sale price is basically that price at which the number of homes selling above that price is equal to the number of homes selling below that price. So this goes all the way back to 2010. As you can see, that was as we were clearing the Great Recession, and it's almost as if you can draw a straight line just going all the way through, right? Even accounting for all the dips and things that have been going on. We did see a little bit of a dip. So this is COVID here, and then we saw right after COVID, the market just took off. All of us during that time were like, what's gonna happen to real estate? And it just, once things started opening up again, it really took off until about 2022, the end of 2022, or the middle, we started seeing interest rates change. And that kind of brought us to the dip, but we have recovered and continued on. In the past years, we've had last year, the all-time high was in May, that's this here, and that was for 2.3 million. So just let that sink in. Median sale price for a home was 2.3 million in May of last year. Since then, it did come down a bit, but it's been hovering around the $2 million mark. So for May, it was at 2,068,000, and it's been kind of just staying steady around there. Months of inventory, that's the metric we use to measure how much inventory do we have. Basically, we take the number of homes that are on the market, don't add any more, and then how long would it take to sell out, to run out of homes to sell. 6 months is generally considered a balanced market, and that's the green horizontal or the blue horizontal line that you see across. That's considered a balanced market. Anything above that is considered a buyer's market. You have a lot of inventory, the buyers have their pick. Anything below that is customarily called considered a seller's market. So as you can see here, since about 2012, we've been in what kind of a market? A seller's market. So have things changed and gone up and down? Yes, they have. But in our area, pretty much when we get up to, say, the highest that we've had in recent times is not even 3 months of inventory. Within this past year, we've seen it go from usually the January, December, January is when you see a little bit higher. January of this year was at 2.1 months. And then it kind of hovers back and forth. May was at 1.8 months of inventory. So even though, yes, there are different specific considerations and location and condition and whatnot, as a whole, we're seeing months of inventory still very tight in terms of what the buyers have out there. Days to sell, this is the measurement of when you put a house on the market until you get an offer accepted, so not till it's actually sold. And here, that first horizontal line that you see is 10 days. So as you can tell, since 2012, about there, it's been hovering back and forth since about to the 10-day mark. So for May, it was 11 days. And if you just think about that in concrete terms, put a house on the market, you have maybe one open house, and then you take offers and go. So that's pretty fast paced. Again, it will depend on your location, your house, the condition, the layout. So, but this is medians for all single-family residences. This is a new metric that I don't always use. I don't know if you can see it well on the screen, but I do have it in the slides. And this is from our multiple listing service, MLS, and they do a weekly update. They provide a weekly update with a bunch of different metrics. Here, what I'm showing is weekly active listings on the market and weekly new listings on the market. And then the dark blue line is this year. The other lighter lines that you see in gray are 2024 and 2023. As you can see there, the weekly new listings kind of follow along the same pattern, right, that as the previous years. But now we're seeing the weekly active listings actually higher. And in some places, we're seeing them anywhere from 20 to 30% higher in terms of listings that are staying on the market. So it's interesting. While the days on market the median days is still low, we're actually seeing more inventory kind of staying in the market a little bit longer. And so we're going to continue to track that and see what's going on there. One of the biggest factors, and this is, I think, my last slide for the market update, is interest rates. Right, and I'm sure all of you have heard about that, the impact that they've had on the housing market. So down at the very left, you'll see that was post-COVID, so 2020, 2021. We were at rates 2.5, 3, right? So everybody was experiencing that. And then in 2022, in the middle of 2022, we saw rates jump so much that they almost doubled in a matter of a few months. And that did impact the market a bit because buyers were finding that now their buying power had gone down a bit. So there's that. Since then, it's been hovering up and down between the 6 to 7%, at the highest almost up to 8%. And what we're seeing there is that initially it did cause a little bit of a dip in terms of buyer enthusiasm and buying power, but now it's been a few years, right? So people have gotten used to this idea of if I like a house, I should buy it. And then I can refinance later if rates come down a little bit more reasonable. So we've been seeing that this year, just being on the ground, and I'm part of different groups where we talk about what we're experiencing, we're definitely seeing this, or I'm seeing personally, impact of more listings staying a little bit longer, buyers who are more nervous about buying because the economy feels a little bit uncertain, interest rates, people, all the talk about possible inflation, possible tariffs, et cetera. So that uncertainty always causes people to not do anything. So I am seeing a few people doing that. On the other hand, we're also seeing people who are, out there and buying and seeing the value. So there's still a demand out there, but it's not as automatic. Several years ago, we would have been talking about maybe 10 to 20 offers. Now, if you get 3, 5, 2, 1 offer, you're happy, right? So there's that impact. But of course, again, it depends on your specific location, the specific property, and whatnot. So that's there. So we'll continue on monitoring the market. But with that, I'm going to go ahead and turn it over to Jason. So those of you who've been to my seminars before, I've handed this book out. It's called How to Retire from Being a Landlord. And Jason McMurtry is actually one of the authors of this book. So, when I got to meet him, I was really impressed by the fact that this company doesn't just give you products, they actually care, and they want to know about each client's specific situation, and will tell you if it's not the right product for you. And I think that's always good. Like, as real estate agents, there are sometimes when I go, yeah, I don't think you should buy that house. It doesn't fit you, or it's too much or something, right? So to be able to find somebody who's willing to share, who's willing to educate, and that I feel like we really relate in many ways because of that, and I'm very thankful that he's able to come up here tonight. So please welcome Jason, and we'll go ahead and hand it over to him.
Thank you, Jean. I have to give credit where credit's due. The other author of the book is Richard Gann. And if Gann sounds familiar, it's because Richard's grandfather is Paul Gann, who along with Howard Jarvis wrote Prop 13. So we have him to thank. And so Richard was actually the president of the Gann Taxpayer Organization for a long time. He's been a tax crusader since I met him 27 years ago. So have to give credit where credit's due. I want to thank Jean for having me. I really appreciate it. And before I get started, just like Jean did, I have to give a little disclosure. So I'm going to be talking about various tax strategies and legal strategies and investment strategies. I'm not a tax advisor. I'm not giving tax advice. I'm not an attorney. I'm not giving legal advice. And I'm not giving any specific investment advice either. I'm going to be talking about various investment strategies. This is not an offer for any of those investments. If you ever get an offer from me or anybody at my company, it would be with a private placement memorandum or a prospectus as required by the regulators. So as Jean mentioned, I wrote a book, How to Retire from Being a Landlord. covers everything that I'm going to talk about today and a heck of a lot more. A little bit about me and my company. Going on 8 years ago, I left a real estate investment company and started 1031 Capital Solutions. We have about 15 people in our company now, and we have offices all over the West Coast, as you can see on the map there. However, our clients are all over the United States, and the real estate investments that we have are all over the United States. So we're not regulated just to the West Coast here. Between my partner and I, Rick Gann, we've got decades and decades of experience, and the only thing that we do is help people that are selling investment property get out of that property and into something else without paying tax in a way that meets their needs. And there are several strategies, and I'm going to touch on those, but one of the big ones, as Gene pointed out, is the Delaware Statutory Trust. So what I'm going to cover today, 3 broad topics. One is why somebody might want to sell their rental property in the first place. Real estate has been a phenomenal investment for most of our lifetimes, but there comes a time typically in people's lives when they want to retire that they start thinking about selling. We'll talk about why they don't sell, and then some solutions to those problems. And that's really all we're going to cover today. And then I'm going to leave a lot of time at the end for questions. I usually find that's the best part of the meeting. So, as I mentioned, real estate for probably everybody in this room has been a wonderful investment. It is a wonderful investment. It absolutely is. It has the potential to provide fantastic monthly income, appreciation, wonderful tax benefits. We get to provide a benefit to society. It has a lot of really great benefits. But when people get into their 60s and their 70s, and they're watching their friends retire from Google and Facebook and Apple or whatever company they're worked for 20 or 30 or 40 years, those people get to stop working, and they get to live on the income that they saved in their 401ks or IRAs or whatever their retirement plans were. And so they get income for the rest of their life, but they don't have to work anymore. But people that built their retirement plan with real estate find that when they get to the retirement years, they can't retire. They still have to work. And they might go out and get a property manager to ease that burden, but when a tenant sues the property because somebody slipped and fell, the owner is back managing that property again. They have to go to court and deal with whatever it is. If it's time for a new roof, the owner's writing a check. If the tenant's not paying rent and it's a serious problem, or you have to replace appliances or whatever the case may be, the owner is still involved, and it doesn't matter if they're 60 or 70 or 80 or 90. I have clients that came to me in their 90s and they say, I want to get out. Right? I've done my time. I want to get out of the real estate. But they don't. Even though it might be difficult to manage, even though the tenants might be difficult, even though after 20 years now they've got to go in and start putting a lot of money into the property, they don't do it. Even though in the last, 5 years, now we have statewide rent control, we have just cause laws. I know people in their 70s that go to meetings regularly just to keep up on all the new rules and regulations so they don't get sued inadvertently. And so it's really a problem that when they were younger, they were okay with it. They dealt with it. It's like, this is the cost of being in real estate. But when they get into their 60s, 70s, and 80s, they just don't want to deal with it anymore. That's kind of the realm of the obvious things. The next thing I'm going to talk about is usually not so obvious to the people that I talk about. In fact, it usually surprises them. And that is, there's a very good chance that a rental property, particularly in this area, is not a very good investment right now in terms of the current yield. Now, why do I say that? A typical example is somebody comes to me and says, I bought a property, say 15, 20 years ago, and when I bought that property, I did the math. How much rent do I collect? What are my expenses? And how much cash flow do I have? And then I say, how much cash flow is that as a percent of my investment? In other words, what's my yield? And it was 8%. 20 years ago, I bought this property, got an 8% yield. And guess what? Rents have only gone up since then. So if it was 8% 20 years ago, who knows what it is now, but it's got to be better than 8%. Well, what they're forgetting is that while that rent was going up every year for the past 20 years, the value of the property was also going up. And in this area, the value of the property was going up much faster than the rent was going up. And that's a good thing. It's not a bad thing. It means that the owner got increasing cash flow and the principal of their investment went up. Everything worked great. But when we do the math today, when we figure out what the yield on their equity is today, it's often very, very low. It's usually less than a CD in the bank because the equity went up. So the denominator in that equation got higher and higher. So it's very common for somebody 20 years ago had an 8% yield sitting on a 2 or a 3% yield today. Now, we created proprietary software that we use, so we'll sit with the client and we'll ask them a few questions about the property, and in about 5 minutes we can figure out what the current yield is. We also have made that software available to you. So if you want to go to exchangeillustrator.com, you can plug that in and figure out what your yield is as well. It's free software, you can do it anywhere. But what they find is, okay, so I'm dealing with the tenants that are a headache. I'm dealing with all the regulations and new laws and rules that are a headache. I got to put a bunch of money into the hardscaping and the roof and the HVAC, which is a headache. And my reward for all of this is a 3% yield. So those people are coming to us and saying, I don't want to be in the property anymore, but I definitely don't want to pay tax. And that is the number one reason that many people keep the properties that they're not excited about owning. Their financial plan goes something like this. If I sell it today, I'm going to pay a huge tax bill and I don't want to do that. So I'm going to keep the property until I pass away. Because when I pass away, there's a full step up in basis and my spouse or my kids are going to get the property tax-free. So that's their financial plan, to just grin and bear it for the rest of their life and hold on so that their family can get the step up in basis. Well, there's a better way. In fact, there are several other ways, and that's what we're going to talk about. So let's talk about the tax for a second, because how the tax is calculated and all the taxes that are involved sometimes surprise people. When I generally meet with people, they often think the taxes work something like this. And what this is a hypothetical example of a property that was purchased 10 years ago for $500,000. And over the last 10 years, it's gone up 3% per year. So the current value is $650,000. And what some people think is, well, it went up $150,000, so I pay tax on $150,000. If I were to sell it today, I'm going to pay tax on $150,000. But what am I forgetting in this analysis? Anybody? Depreciation recapture. Yeah. What people forget about is the fact that every year I got a tax write-off, which was great, against my income. I got to depreciate the property and get a deduction on my income. But every time I did that, my cost basis in the property went down by an equal amount. And it's not uncommon for the depreciation, which is about 3.6% per year, to be equal to or greater than the appreciation. So what we find is after 10 years, the property appreciated by 30%, but the cost basis went down by 36% or 36.4%. So the new adjusted basis is $318,000. So to figure out what your capital gain is, you have to take your $650,000 sales price. And by the way, we're using that as a net number. So that's after commissions and closing costs and all of that. So you take your $650,000 sales price, you subtract your $318,000 basis, that leaves you with a $332,000 capital gain. So roughly a third of that is about $100,000. How did we get there? Well, 20% long-term capital gains tax. Now some people might say, well, it might be 15%. It might be, but usually when you sell a large property, that gets added to your income, and so it's pushing you into the 20% tax bracket, even if you weren't in it before you sold the property. So you got 20% long-term federal capital gains tax. You have 25% depreciation recapture tax on that 36.4% depreciation. You have net investment income tax of 3.8%. And then, of course, in wonderful California, we've got as high as 13% tax, depending on your tax bracket. So you add all that together and you're paying about $100,000 in tax. Now remember, you only got $150,000 more than what you put in. You put in $500,000, it grew to $150,000, so of the $150,000 you're getting, you're writing a check for $100,000 to the federal government and to the state of California for taxes. That is why people don't sell, is they look at that analysis and they say, forget it, I'll just grin and bear it, I'll hold on, I'll keep the property forever, my estate will get a step up in basis someday and we'll escape that tax. There are about 6 common ways that you can sell the property and not pay any tax. Qualified opportunity zones, charitable remainder trusts, intermediary installment sales, oil and gas programs that have tax credits, Delaware Statutory Trust, which is what we're going to talk about today, and 721 UPREIT, which is a cousin of the Delaware Statutory Trust. It's kind of a version of the Delaware Statutory Trust. So what we do in my office when somebody comes in is we will talk to them and find out what's the situation. Tell me about the property, the equity amount, the debt amount, your total picture. What do you want? If you could wave a magic wand, what would you want to happen? What's important to you? Is it income? Is it growth? Is it liquidity? Is it safety? Is it diversification? Everybody always says yes, 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 yes. But how do we prioritize those? What are the most important things? And then we consider all of these factors, all of these potential strategies. And then we will come back and say, this strategy does or does not make sense. This strategy does or does not make sense. The vast majority of the time, more than 90% of the time, the best solution for the clients we're talking to are the DSTs, the Delaware Statutory Trusts. And so that's what I've been asked to focus on today, and so that's what we will focus on. But just so you understand our process, we're looking at all of the strategies, and if there's a better strategy out there, we'll let you know. We'll let you know that. And we may or may not be able to help you with that depending on what that strategy is. All right, so you guys are going to have to participate now. This is a little audience participation here. So I'm going to read through this and we'll get to the fill in the blank and let's test your knowledge on 1031 exchanges, because this is sort of the basic knowledge we have to have, the fundamental knowledge we have to begin talking about DSTs. In a complete 1031 exchange, meaning where you can defer all of the, what kind of tax can you defer? Capital gains tax. Thank you. Okay. Capital gains tax that you would otherwise have to pay. When you conduct a 1031 exchange, all proceeds from this sale must go directly from escrow to a qualified intermediary. The most painful calls I get, and I get about 2, maybe 3 a year, is when somebody calls me and says, yeah, I just sold my property. I want to do a 1031 exchange. So-and-so told me to call you. And I say, that's great. Who's your exchange accommodator? And they say, what's an exchange accommodator? And I say, well, looks like we're not doing a 1031 exchange. Once you receive the funds, there's no going back. You can't send them back and undo it. Once you receive the funds, you pay tax. You have constructive receipt of the funds. To avoid that, you just call a company called an exchange accommodator, qualified intermediary, QI, all different words for the same thing, just to make it extra confusing. But they all do the same thing. They just hold the funds after the sale until you figure out what you want to buy, and then they send the funds to the seller or the DST or whatever you're going to do. And you're involved with them, but that's how that works. Your real estate agent's going to have a company for you, just like to have referrals for appraisers and inspectors and all that good stuff. All right, so it has to go to, sometimes this works and sometimes it doesn't, qualified intermediary. Okay, after you close escrow on your relinquished property, you have how many days to identify your replacement property? How many days? 45 days. And then how many days do you have to close on your replacement property and have everything completely done?
6 months.
Yep, so how many days from the day you sell the property? 180 days. Right? So it's not 180 additional days, it's 180 days from the initial sale of the property. Which one of these causes people more heartburn, the 45 or the 180? 45. The 45. It's the 45. 6 months is plenty of time to buy your replacement property, right? And the truth is, I understand why there's a 6-month limit. You can't sell your property and not pay tax on it and then just drag your feet and not buy a replacement property. So there needs to be a window, and I think 6 months is a reasonable window. Why there's a 45-day requirement that you have to identify and all of a sudden reduce the number of options from every property in the United States to the 3 you put on your ID letter, I don't have any idea why that's a requirement. Makes no sense, but that's the way it is. Okay, to successfully defer all the taxes in a 1031 exchange, you must replace the entire value of your rental property. This means replacing all of your equity and this is what gets everybody, and all of your debt. So in 2004, the IRS took a look at the DST to see, does this work? Because you probably know you can't sell a property and do a 1031 exchange into a mutual fund, even if that mutual fund owns only real estate. And you can't do a 1031 exchange into a partnership or an LLC, even if they own real estate. You can't even do a 1031 exchange into a real estate investment trust, even though it's only real estate. But for some reason, this trust you can. Well, why is that? And it's because it's structured as a trust, as opposed to an LLC or a partnership or a corporation. And the trust is a pass-through entity. So the IRS said, yep, this flies. You can do a 1031 exchange into a DST, and you can do a 1031 exchange out of a DST because it's like-kind property. It qualifies. Speaking of like-kind property, this is another thing that people get mixed up quite a bit. Like-kind property used to have used to be meaningful, because up until 2018, you could 1031 exchange real estate, but you could also 1031 exchange airplanes and art and other capital assets that were held for investment purposes. And the term like-kind meant if you sell real estate, you can replace it with like-kind real estate. If you sell an airplane, you can replace it with an airplane. You can't sell an airplane and replace it with real estate. That's what like-kind meant. Well, then in 2018, they did away with 1031 exchanges for every asset except real estate. But this like-kind concept stuck around and confused everybody. It made everybody think, oh, well, it must be if I sell a commercial building, I have to replace it with a commercial building. If I sell an apartment, I must have to replace it with an apartment. Not the case at all. Real estate for real estate. Doesn't matter what kind of real estate, it's real estate for real estate. So the IRS said, yes, you can do this. They put rules in place, which I'm going to cover in a little bit, but they said you can absolutely do it. It's about $8 to $10 billion a year industry, and it's primarily driven by the baby boomers that are getting to the retirement years. They want to simplify their life, and they don't want to manage property anymore, and so they sell it, do a 1031 exchange into a DST. The reason these are so attractive is because you get the benefits of real estate, the potential for cash flow, potential for appreciation, all of the tax benefits that go with being a real estate investor, with none of the operational responsibilities whatsoever. So this is how a DST works. It's a real estate investment company, typically a very large, like an institutional real estate investment company. They will use their resources and their connections and their knowledge, and they will go out and find what they think are the best properties in the best markets throughout the United States. And let's say they find a 400-unit, relatively new apartment building in Denver, Colorado. They're going to go out and get an appraisal. They're going to get the inspections. They're going to look at the rent roll. They're going to do all the market research and due diligence. They're going to do engineering reports, all of the things that anybody would do if you're going to spend $100 million on an apartment building. And then they're going to finance it, maybe, right? They could pay all cash, but a lot of times they'll put a loan on it, which means that they're dealing with the lender and they're paying all the points for the lender and all of that stuff. And then they're going to buy the property. And then they're going to go to an investment bank and they're going to say, this property, we want to turn it into a DST so somebody can invest $100,000 or $1 million or $10 million or whatever and own part of this property. And so they go through that process and they work with broker dealers and financial advisors, which is what we do in this whole scheme. And then they put it out to the market. So after we review it and do our due diligence and decide that this is a good investment, and we present it to our clients and they can look at the appraisal and the inspection and all of the things, all the work's been done. So if you decide as an investor, yeah, I want to do my 1031 exchange and invest in this, you can look at all of the material in a couple hours and go, yeah, I want to do this, and 4 days later you own it. There's no escrow process. There's no loan approval process. It's already been done. So you can review all of those documents and decide yes or no. And if you decide yes, 4 days later, you're an investor and you're earning your cash flow immediately and it's paid monthly. I mentioned the loan. So if somebody sells a property and there's no loan on it, then they don't have to worry about a loan. But let's say somebody sells a $1 million property and they have a $400,000 loan, and that loan gets paid off and they have $600,000 of equity. Remember I talked about you have to replace the value of that loan. Well, DSTs have to follow the same rules as everything else in a 1031 exchange. You have to replace the value of the loan. But remember I said the DST company already bought the property, and if they already used a loan to buy the property, then when investors come in, they allocate pieces of that loan to each of those investors on a pro rata basis. So let's say they bought this $100 million property and they wrote a check for $60 million and they borrowed $40 million from the bank. That's a 40% loan to value. That means for every $6 that gets invested in that DST, they're going to get allocated $4 of loan. So it's as though they took out a loan, but they didn't. So if you take your $600,000 and you invest it in this DST, your closing statement is going to say $600,000 of equity, plus you got allocated $400,000 of the $40 million loan for a total purchase price of $1 million. So you have replaced the $1 million that you sold with $1 million of the DST without having to go get a new loan, without making any loan payments, without having liability for a loan. It's not on your credit. You don't make any payments. It's a real loan, but the DST handled everything setting it up, and they make all of the payments to everything, including the loan, before they pay the investors every month. So when you get your check in the mail, the loan's already been paid. The taxes have already been paid. The insurance has already been paid. The property management, the asset management, the bookkeeping, the accounting, the legal, all of that stuff has already been paid, and all you get is a check in the mail that is the net amount after everything has been paid. So the reason that people are drawn to these DSTs is because it's turnkey. It's clean, it's simple. Often the cash flow, not always, depends on the situation, but often the cash flow is higher than the property that they had, and the workload goes to zero. And that's the benefit to it. So let's talk about what these might look like. A typical DST is a single property. So that an apartment building in Denver, for example. And you would look at it, you know exactly where it is. You can go visit the property. Sometimes people want to fly out and talk to the property manager and walk the neighborhood and do the things. Those are always available. Sometimes the DST company, in order to create some diversification and bring down the risk, might put 2 properties or 3 properties. I've seen as many as 30 properties in a single DST. So you might put in $100,000, but rather than going into one property, it's spread across all these properties and you get this diversification. And there's pros and cons to that. The portfolio value, generally 25 million to 30 million, maybe 50 million. Some are larger. Lately we've seen $100 million, $200 million portfolios. Minimum investment's usually $100,000 if you're doing a 1031 exchange. And the property could be any type of property, and it could be anywhere in the country. But it tends to be really high quality apartment buildings, self-storage properties, industrial buildings leased to like Amazon or FedEx, those types of properties. Those are the majority, and the majority of the properties are located in no tax states or low tax states, because those are the areas that are drawing the companies, which bring the employees, which grows the population, which increases the rent, which increases the value. That's generally what we're looking for. Almost never see a DST in California. The prices are too high, the taxes are too high, the regulation is too high, cap rates are too low. Meaning it's very difficult to get positive cash flow because the prices are so high. So we see a lot of properties in Texas, Arizona, Nevada, Tennessee, Georgia, the Carolinas, Midwest, Southeast types of areas. A typical hold period for a standard DST is 5 to 10 years. So one of the characteristics of these things is that you're investing in a property and they're going to manage that property for 5 to 10 years. It's usually around 6 years, but we don't know. They're going to hold it for a period of time and then they're going to sell it. And when they sell it, they're going to let everybody know. You usually get about a 2-month notice and you decide what you want to do. So when they sell it, hopefully you made money. So if you put in $1 million, hopefully you get back more than $1 million, plus you got your cash flow along the way. And then when you get it back, you can either pay the taxes and spend the money if you want. Nobody ever does that, but you could. Or you can do another 1031 exchange into another DST. Or if you wanted to go be a landlord again, you really missed it, and you're miss dealing with tenants, you can go buy another property with your real estate agent. It's like-kind property, it's just real estate. So you can do that if you want. Or you can kind of split it up. Sometimes people will go some DST and then some cash out or whatever you want to do. But that's your choice. But there's no liquidity in the meantime, right? Because all the money that you put in went to buy the property. So if you come back and say, hey, I want my $1 million, they can't like chip off part of the building and sell it. It's not possible. So you have to be comfortable with having the money invested for income for a relatively long period of time and not know exactly when it's going to come back. It might be 5 years, might be 6 years, might be 7 years. You don't know. It generally cannot be more than 10 because of the way they're structured. Some can, but we would let you know. The debt, like I say, if you don't have any debt on the property you sold, you don't need any debt in a DST necessarily. You could go into one that has debt because you like it, you like the property, you like the location, whatever, but you don't have to. But if you come out of your property with a 20% loan to value, for example, then you need to go into DSTs that have a 20% loan to value or higher in order to not pay any tax on the transaction. So that's part of what we do, is help people figure that out. The first year cash flows in today's market right now are somewhere in the range of 4% to 6% cash flow. Now let me explain what that means. That means when the DST company collects all the rent and then they pay all the current and future obligations, what's left is about 4 to 6% of the original investment. So they collect the rent, they pay the property management, asset management, the taxes, the insurance, the mortgage, maintenance, repairs. Those are all the current expenses. But then they know when they bought the property, you know what, we need to put a roof on in 4 years or replace a roof or whatever. So they're budgeting for that every month. Oh, we know we're going to have turnover and vacancy, so we're budgeting for that. And so they're not just living off the current financials, they're also projecting into the future and budgeting for that. So they're sweeping some of the cash flow that they would have sent to you so that they don't run out of money 4 years from now when they need to put it on the roof. So that range, if you put in $1 million, the bottom is about $40,000 a year of positive cash flow that you would receive. It's usually paid in monthly payments, but at the end of the year, $40,000, up to about $60,000. What does that depend on? How much risk you're taking. And what does that mean? What type of property are you investing in? So if you're looking at a really high quality apartment building in a very good market, you're looking at 4.5%, maybe 4 3/4. If you're looking at a hotel in the middle of the country, you're closer to 6, right? Because the variability of your cash flows is just riskier. And they're almost always paid monthly. Every once in a while, they're on a quarterly basis. So far, what I've been talking about is what we call a traditional DST. It's locked up 5, 6, 7, 8 years later. They're going to sell it. You get your money back, and you can roll that into another DST or another property if you want to. The cousin that I talked about, the other version of a DST, is called a 721 UPREIT. This is very attractive for people typically that are a little bit older. They're 100% positive that they never want to go back and be a landlord again. So when I say, hey, you're going to get your money back in, call it 6, 7 years, and you can either put it back into another DST or you can roll it back into a property and be a landlord again. And then they say, no, I don't want to do that. In fact, if I could wave a magic wand, I wouldn't even go through that process in 7 years. Sometimes people come to me and they're pushing 80, and they go, I don't want to be in my mid-80s and do another 1031 exchange. And by the way, do I got to pay all the fees again? Yes. Got to pay the exchange fees, the commissions, and all that stuff. They go, so 7 years from now, I got to do something I don't want to do, and I got to pay a bunch of money to do it? Yeah. Okay, so the REIT might be a better strategy for those folks. And here's how the REIT works. You go into a DST, so it actually starts as a DST, but rather than the company selling the property in 5 to 10 years and then you having to kind of come back to the table and do something, the DST automatically gets merged into a REIT in about 2 years. Sometimes it's 2 years and 2 or 3 months or something like that, but about 2 years from now, it automatically goes into the REIT. You, as the investor, don't do anything. You go into the DST knowing that it's going to go into a certain REIT and you want to be in that REIT, and so you sort of set it and forget it. And in about 2 years, in a few months maybe, it goes into the REIT through a tax-deferred 721 exchange, so it does not create any tax liability, but you'll get a letter that says, congratulations, the DST that you owned is now part of this broad REIT that owns 100 or 150 commercial properties. And now your cash flow is based off all of these properties, and your return is based on all of these properties. It's professionally managed. So if there's a property that's underperforming, they're going to get rid of it and buy a better property. If interest rates come down, they're going to refinance the loans and create more cash flow for you. They're going to do really good things to protect your investment, grow the cash flow, grow the value of the investment. But the beauty is, they're never going to sell the REIT and make you do anything. They're going to manage it in perpetuity. If you want your money back, you sell the shares of the REIT. Or you pass away and your spouse sells the shares of the REIT. Or your children sell the REIT. So most of my clients, what they want is a stable place to put the money. They want to defer the taxes. They want to get regular income for the rest of their life. And the fact that they can get to it is kind of a nice bonus, but they don't plan to get to it, but they can. But when spouse number one passes away, there's a full step up in basis. Now there's no more capital gains tax. The surviving spouse can sell it if they want to, and they can put it in the bank if they want to. Or they can leave it there because it's producing income and they love it. And then when the second spouse passes, the kids can either leave it and live off that income, or they can sell it and buy the Ferrari that they've been waiting for the past 10 years. The choice is there's options, right? And so when we work with clients, they get to decide, do you like the standard DST where in 5 to 10 years they're going to sell it and give you the money back? Or do you like the REIT strategy that's automatically going to go into the REIT and have these benefits of diversification and potential liquidity? In my opinion, the number one reason that everybody doesn't go into the REIT, this is the big catch to it, and it's really only a catch to some people, is once it goes into the REIT, it changed its characteristic. It's no longer like-kind property. So it doesn't create a tax bill when it goes into the REIT, but you cannot 1031 exchange it into a rental property anymore. When you sell it, you're generating potential tax, unless there's a step up in basis and some other things. And so for some people, they go, I don't care, I never want to buy a property ever again. It doesn't matter to them. Some people say, well, I really want the option. I really want to be able to buy something if I want to. And there's no right or wrong answer. People have different needs and objectives, but those are the types of things that we talk to clients about to figure out what's best for them. So let's kind of recap, and then we'll talk about the not as fun things. What are the risks? What are the downsides to all of this stuff? DSTs, whether you're talking about a conventional DST or the UPREIT, they're 100% passive. You don't have an escrow process. You don't have loan approvals. You're never getting a phone call from a tenant or a property manager. There's built-in liability protection. You can never get sued because of something that happened in the property. It's like owning an ETF. It's that sort of passive and remote. You have the potential for cash flow and appreciation. All the tax benefits still accrue to you. You get the depreciation write-offs. You're just not involved in it at all. Institutional property management, institutional asset management. You don't have to get a loan. Yeah, I think I said all that. Okay, so let's talk about why somebody might learn all of this stuff and then decide that it's not for them. Or why would we recommend that somebody not do a DST? Easiest thing to do is talk about, like, what are the risks? The risks are the same exact risks that somebody has in any other piece of real estate. So if you own a rental property and the tenant doesn't pay you rent, do you have cash flow? Of course not, right? Same thing in a DST. If interest rates, I don't know, nearly double overnight, is it going to hurt the value of your rental property? Yes, and it also hurts the value of rental properties in DSTs. If we go into a recession or a depression, or if the banks stop lending and the market seizes up, is that going to affect your rental property? Yes, and it's also going to affect DSTs. So the fact that it has an institutional component to it, the fact that it is offered through advisors like myself, does not put any guarantees on it that real estate doesn't have, generally speaking. So your cash flow can go down. The value of your investment can go down. Like, just real estate 101. The difference really is that you can't sell it when you want to. Unlike the property that you own today, assumably, if you decided tomorrow, I'm just going to sell this, I don't like the way the things are looking, you can list it and assumably sell it. Right now you can sell it pretty quickly. Where if you go into the DST, you can't sell it. You have to wait for the company to sell it. And so that's something that you would have to decide if you're comfortable with that. If you go into the REIT, you can sell it when you're in the REIT, but that takes time. You can't do that immediately because of the waiting period. The fees and expenses. So this one's kind of confusing because I've seen DSTs out there. Let me back up. There's about 80 or 90 DST companies, and usually they all have at least one DST available. Some of them have 2 or 3 available at once. So there's maybe 100 DSTs available today and every day. They're different because they come and go, but there's maybe 100 available. I would say 65 or 70 of them, I would never recommend that anybody invest in ever, because the company is too new, they don't have a track record, the fees are too high, the loan is a variable rate loan or a short-term loan that has a lot of risk, the property is in the middle of nowhere, or it's really old, or the tenants aren't credit tenants. There's a bunch of reasons that I wouldn't recommend it. And so when I talk about DSTs, understand I'm talking about the entire universe. I've seen DSTs with fees as high as 30%. So you put in $100,000 and $30,000 is going to pay all the fees and expenses, right? I would never recommend that somebody invest in one of those, but they're out there. I've also actually offered a DST to one of my clients where the fee was less than 2%. So it really just depends on the DST and the amount that you're investing in the total structure. The average is about 7 to 10%. And what I mean by that is if the DST company goes out and buys a $100 million property, they're going to add all of their out-of-pocket costs. They had to do all the due diligence and arrange the financing, and there's a broker that is involved that has to get paid and all of that. So they had to pay a bunch of money to buy that property. Then they had to go to an investment bank to turn it into an investment. They had to pay them. Broker-dealers, financial advisors have to get paid for bringing in consulting clients. So when you add all of those costs, what they do is they say, well, we bought it for $100 million, but all of our costs were $8 million, so we're going to add that to it. So now we're raising $108 million from all the investors. And that extra $8 million goes to pay for all the fees and expenses. That's about average. That's about what you're going to see. The cash flows, the 4, 5, 6% that I talked about, have already factored in whatever the fees and expenses are. So the bottom line to the investor would be the 4% or the 5% or the 6% or whatever it is. But it takes time. Over time, the rent goes up, the value of the property goes up, and you have to make that up. If you were to buy it today and then sell it tomorrow, you'd be out the 8%. But that's true for any piece of real estate. You buy a house today and sell it tomorrow for the exact same price, you lost money because of the transaction costs. So it's very much the same. You have to be an accredited investor. These are regulated by the Securities and Exchange Commission and FINRA. And one of their rules is to invest in a DST, you have to be what's called an accredited investor. And that means you have a net worth of $1 million or more, excluding the home that you live in. So you add up your checking, savings, investment, all your real estate, including the property that you're selling, if all that adds up to over $1 million, you're accredited. If it doesn't, then the government won't let you invest in these. So we have two main services. One is the brokerage service that I've talked about. Sometimes people come to me and they say, I know all about a DST, I've done all my research, I just need an advisor to help me pick the best one and help me get it done. Can you help me? Yes, we can help you. That would be through our brokerage service. The DST pays us a commission to do that. They get the money to pay us from the investor, just like I talked about. That's how that works. The other service that we have is advisory service, which is sometimes people come to us and they say, I know I want to sell my property. I know I don't want to pay tax, but that's about all I know. And so rather than us just saying, well, here's a DST, and then having them compare it to 3 or 4 other options, we say, okay, we'll learn about you, what you want to accomplish, the property, and we'll put a report together. It's usually about a 25 or 30 page report, and we will consider a qualified opportunity zone strategy, a charitable remainder trust, an installment sale, energy tax credits, DSTs, 721, and we will consider all of these strategies. And then with our fiduciary duty hat on, meaning that we are legally required to act in your best interest to give you honest and complete education and advice, we'll give you recommendations on how suitable each of those strategies are or are not. And we charge a pretty small fee, $390, to provide that report to you. And then you could take that report to anybody. Let's say DSTs were the right solution for you. You could take that to any advisor that offers DSTs and say, hey, I know now because of this process I want DSTs, can you help me? If you want us to be the broker that helps you with that, we're happy to do that too. So those are the two main services that we provide.